Welcome to the deep dive. So if you are sitting there listening to this, you're likely gearing up for your MBA exams. And, well, consider this your ultimate memory-locking study companion.
Absolutely. We're getting into Chapter 9 of your notes today, which covers behavioral finance anomalies. And honestly, this isn't just dry academic theory you have to memorize.
No, not at all. It's almost like a cheat code to understanding why supposedly rational financial markets actually act completely crazy most of the time.
Right, because everything you've learned in your standard economics courses about perfectly efficient markets, well, it might just be a myth that completely ignores actual human psychology.
Exactly. I mean, traditional finance models, they feel a lot like those high school physics problems, the ones where the instructions boldly state, assume a perfect vacuum.
Oh yeah, ignore air resistance, assume a frictionless surface.
Right, and you sit there, you crunch the numbers, and the math is just absolutely flawless on paper. You drop a feather and a bowling ball, and the equation proves they hit the ground the exact same millisecond.
Because in a vacuum, they do.
Right, but the moment you step out of that classroom and onto an actual trading floor, you drop the feather and the bowling ball, and reality hits. The real world has friction. And, in financial markets, human emotion is that friction. It just breaks the perfect calculator.
That friction is precisely what we are exploring today. And for your exam, this is arguably the most vital concept you can master before stepping into a professional role. We're unpacking the core framework of behavioral finance. So we are going from the foundational differences against traditional finance down to the specific biases, the emotional market cycle, and even the academic critiques of the field.
So we're giving you the diagnosis for why those mathematical models you're learning in your other classes will sometimes just completely fail you.
Yeah, to understand the cure, we really first have to understand the original baseline that economists were working from.
Okay, so let's set that baseline. This is section 1 of your notes, the Great Divide.
Right, so the entire foundation of modern financial theory, this is the stuff that came out of the University of Chicago back in the 1950s, it rests on one monumental assumption.
The mythical Homo economicus.
Exactly, the rational economic man. Traditional finance insists that whenever an investor makes a decision, they gather every single piece of available data.
Every single piece.
Yep, and then they process it flawlessly without any bias whatsoever and execute a trade that perfectly maximizes returns while minimizing risk.
I mean, that sounds like a supercomputer, not a human being.
It does. It assumes that market prices are simply a perfect mirror reflecting the unvarnished intrinsic value of an asset.
But I mean, eventually psychologists looked at this framework and pointed out the glaring flaw, right? People are not spreadsheets.
No, we really aren't. We get tired, we get scared, we get overly excited because maybe our neighbor bought a boat with his crypto games.
Yeah, that FOMO is real.
And that realization birthed behavioral finance. It essentially takes the elegant math of traditional economics and smashes it into the messy reality of human psychology.
So it proposes that we don't process data perfectly. We use mental shortcuts.
Right. And those shortcuts lead to predictable, systematic errors in how we price assets. Security prices don't just reflect fundamental value, they reflect heuristics, emotional biases, and social influences.
Okay, so let's get into a huge exam concept here. Prospect theory.
Oh, yes. Prospect theory is a cornerstone. So traditional finance argues that people evaluate their overall total wealth when making decisions.
Okay, meaning what exactly?
Meaning, if you have $10 million, a $10,000 loss shouldn't psychologically devastate you because, hey, you were still a multimillionaire.
Right, the math says you're still rich.
But prospect theory revealed that humans don't think in absolutes. We think in trajectories. We evaluate potential gains and losses relative to a specific reference point.
Like the price we originally bought the stock at.
Exactly, the status quo. So it's not about how much money you have in the bank, it's about the fact that the stock you bought yesterday for $50 is now only worth $40.
And that localized drop triggers a real physical reaction.
It does. Prospect theory tells us that the pain of losing that $10 is felt exponentially more intensely than the joy of making $10.
Wow. So our brains are just hardwired for loss aversion.
They really are. And this psychological quirk manifests in the markets as a phenomenon called the disposition effect.
Okay, hold on. Listeners, highlight this. The disposition effect. This is definitely going to be on your exam. What is the definition here?
Because we are so averse to realizing a loss, investors will stubbornly hold on to a plummeting stock, just hoping beyond hope that it bounces back to their original purchase price.
They just refuse to sell.
Right, because hitting that sell button transforms a paper loss into a real permanent defeat. The ego can't handle it.
Meanwhile, if a stock goes up, that same investor will sell it incredibly fast, right?
Yeah, exactly. They want to lock in that psychological rush of a win, even if the fundamentals suggest the stock has massive room to grow.
So they end up cutting their winners and watering their losers?
Which is the exact opposite of a profitable trading strategy. The math says you should reevaluate the asset based on today's information. If the outlook is bad, sell it and deploy that capital somewhere better.
But the ego just cannot accept the loss. So how do we fix this? The notes mention something called hedonic framing.
Yeah, hedonic framing is a mental hack to bypass the disposition effect. It's a way of actively restructuring how you group your mental accounting.
Okay, walk me through the mechanics of that. How does it trick the brain?
Well, because the pain of a loss is so acute, if you have multiple losses in a portfolio, you should mentally bundle them together into one single event.
Ah, so you take one big emotional hit rather than torturing yourself with 5 individual cuts.
Precisely. And conversely, because the joy of a gain diminishes at the margins, you should segregate your gains. If you have 2 winning stocks, you evaluate them separately to maximize the psychological reward.
So by consciously shifting how you frame the outcomes, you reduce the emotional friction that prevents you from making the mathematically correct choice.
Right. You hack your own reference points.
That is fascinating. Okay, let's synthesize this first section for the exam checklist. We need a direct comparison between traditional and behavioral finance across 4 main pillars.
Let's do it. Pillar 1 is data processing.
Right, so traditionalists believe humans execute complete and correct data processing.
But behavioralists know we rely on improper, flawed rules to process information.
Okay, got it. Pillar 2 involves the perception of risk and return.
The old guard claims decisions are based entirely on objective calculations of risk versus return, regardless of how a problem is presented.
Whereas the behavioral camp proves that how a choice is framed completely alters an investor's perception of its risk. We just saw that with hedonic framing.
Exactly. Then pillar 3 is the actual driver of the decision. Traditional finance assumes reason and logic take the wheel.
And behavioral finance argues that instinct and emotion are actually driving the car, often with logic stuffed in the trunk.
I like that analogy. And that leads to the 4th pillar, the ultimate divergence, market efficiency.
Right. Traditional theory assumes perfectly efficient markets where a security's price is always an unbiased estimate of its true intrinsic value.
But behavioral theory contends that because of our emotional biases, fundamental value and actual market price can diverge wildly for extended periods.
So if our mental processing is that flawed, we really need to know exactly what those flaws look like.
We do, and that brings us to section 2 of the notes.
The menagerie of errors, which the text mentions there are over 100 distinct behavioral biases. How is an MBA student supposed to categorize all of those?
You don't need to memorize all 100. For practical application, you can group this menagerie into a high-level taxonomy: ego bias, information bias, emotion bias, attention bias, and conservation bias.
Okay, ego, information, emotion, attention, conservation. Let's explore how these actually function in the wild. Starting with the ego. There is a specific phenomenon called self-attribution bias.
Yeah, self-attribution is essentially the brain's ultimate defense mechanism for the ego.
I feel like I see this everywhere, especially during a bull market.
Oh, absolutely. When an investor makes a trade and it yields a massive profit, their brain immediately attributes that success to their own intrinsic genius.
Right. They tell themselves, I'm a visionary who saw the macro trends before anyone else.
Precisely the internal narrative. They believe their superior analytical skills won the day. However, when the exact same investor makes a trade that loses 40% of its value, the narrative instantly shifts.
Suddenly, it's not their fault.
Right. It was an unpredictable macroeconomic shock, or the Federal Reserve acting irrationally, or nefarious market manipulation by hedge funds.
So success is internalized as skill, but failure is externalized as bad luck.
Exactly. And the real danger here for a student or a professional is that it entirely short-circuits the feedback loop required for learning. If you never admit you made a bad call, you will never refine your strategy.
That makes total sense. And that ego preservation links closely to how we gather information in the first place, right?
It does. Which brings us to information bias. And here we need to distinguish between 2 distinct processing errors for the exam: cognitive bias and confirmation bias.
Okay, what's the difference?
Well, A cognitive bias is almost like your mental computer simply lacking the RAM to process complex data. It's an innocent error in reasoning or calculation due to incomplete information or just a sheer lack of analytical capability.
So it's not malicious, you just did the math wrong or didn't have all the facts.
Right. But confirmation bias is much more active and, frankly, insidious.
This is the dangerous filtering of facts.
Yes, it is the human tendency to eagerly seek out and accept information that supports an opinion we already hold, while actively ignoring or discrediting any data that refutes it.
This perfectly explains why bulls remain bullish and bears remain bearish regardless of reality. Like you see this reality distortion field around certain polarizing tech companies.
Oh, absolutely. If you are a perma-bear on an electric vehicle manufacturer, you will hyperfixate on a report about a minor supply chain delay and treat it as undeniable proof the company is doomed.
But meanwhile, you will entirely dismiss their record-breaking quarterly delivery numbers as a fluke or an accounting trick.
Right. You are intentionally blinding yourself to half the board, which guarantees poor decision-making.
And this filtering process, it relies heavily on heuristics, right?
It does. A heuristic is just a mental shortcut. It's a rule of thumb our brains develop to survive a world overflowing with data. We can't perform a deep analytical assessment of every single micro-decision we make daily, so we rely on patterns.
But in the financial markets, relying on these primal rules of thumb causes severe mispricing.
Severe mispricing. Let's look at the first major heuristic trap, representativeness.
Representative. Okay, what does that look like?
This is when we form strong opinions based on stereotypes or superficial similarities. For instance, an investor might assume that because a company makes a smartphone they personally love, the company's stock must inherently be a phenomenal investment.
Oh, wow. So they represent the quality of the consumer product as the quality of the equity.
Exactly. Completely ignoring valuation metrics, debt loads, or market saturation.
Or they project past performance infinitely into the future, right?
Yes. They see a company that has grown at 20% for 3 years and mentally lock in that growth rate forever. They ignore the business cycle or the law of large numbers. They just assume the past represents the future perfectly.
And this natural desire to find simple patterns leads directly into the illusion of control.
Right. The illusion of control is this fascinating dynamic where investors feel certain about an outcome, even when they have highly inadequate information, just because it feels right.
Like the psychological difference between driving a car and riding in an airplane.
That's a great analogy. Statistically, the airplane is magnitude safer. But people feel more fear in the plane because they aren't holding the steering wheel.
So in markets, if an investor builds their own complex, color-coded spreadsheet, they develop an illusion of control over the asset's trajectory.
Exactly. And that leads to dangerous overconfidence in highly unpredictable environments. They trust the data just because they compiled it.
Okay, let's move to a massive exam point. Make sure you get this down. Anchoring. And specifically, how it creates post-returns announcement drift.
Yeah, this perfectly illustrates the failure of traditional efficiency. So let's say a company suddenly announces earnings that completely blow past all Wall Street expectations.
Incredible news.
Right. Now, traditional models dictate that the stock price should instantly gap up to reflect this new, higher intrinsic value. Boom, the adjustment is instantaneous.
But what actually happens in the real world?
Often, the price jumps slightly, but then it continues to slowly drift upward over the next few weeks or months. It doesn't adjust instantly.
And the psychological mechanism causing this lag is the anchor.
Exactly. Investors had a pre-existing valuation fixed in their minds. Even when confronted with hard, undeniable data that the company is suddenly much more profitable, their brains struggle to cut the cord to that old valuation.
So they are literally anchored to their previous beliefs about the company.
They are. So they adjust their assessment reluctantly and gradually. That mental reluctance acts as a drag coefficient on the price movement, creating the slow upward drift rather than the instant correction.
That is so counterintuitive, but it makes perfect sense when you factor in the human brain. And speaking of the brain, we also desperately crave familiarity, don't we? To avoid ambiguity.
We do. Responsiveness to ambiguity is another major bias. The primal mind equates the unknown with danger. So in a modern portfolio, this translates into home bias or own company bias.
Right. I mean, from a purely mathematical standpoint, global diversification is the optimal way to reduce risk.
Right. Yet investors will heavily concentrate their capital in companies located in their home country, or even worse, heavily invest their retirement funds into the stock of the specific company they work for.
Because they fear the unknown.
Exactly.
Well,
They prefer a familiar risk over an ambiguous one. They feel they understand their local market better, even if their local market is empirically more volatile or offers lower returns. It is a mathematical error driven entirely by the emotional comfort of proximity.
speaking of mathematical errors, the notes bring up outright mathematical illiteracy. And look, I don't think this is meant to be insulting, right?
Not at all. It's a documented cognitive limitation of the human species.
Oh,
We did not evolve to intuitively grasp probability or the true weight of massive numbers.
the classic example in the text is the lottery. But I have to ask, how does the lottery example actually prove mathematical illiteracy?
Well, if you asked someone to pick 5 numbers out of 50, the statistical probability of hitting the exact sequence is astronomically low, functionally zero.
Right.
Yet millions of people buy those tickets because they, quote, have a good feeling about their numbers. They attach overwhelming emotional significance to the massive potential payout and completely fail to internalize the reality of the probability. We really only truly understand 0%, 100%, and a murky middle ground of maybe.
And this blindness also creates what the text calls monetary illusion, right? Failing to see nominal versus real changes.
Exactly. This is when investors look at nominal gains without factoring in inflation. If your portfolio grows by 4%, but inflation is 5%, your actual purchasing power has decreased.
You literally lost money.
You did.
Mhm.
But the human brain sees the green plus 4% on the screen and feels the dopamine hit of a victory.
Wow. We also routinely ignore base rates.
Yes. If we read one compelling article about a single startup disrupting an industry, we invest in it, completely ignoring the historical base rate that 90% of startups in that sector go bankrupt.
Because the vivid narrative overrides the boring statistical reality.
Always.
Okay, so taking all these individual micro-level glitches, the loss aversion, the anchoring, the narrative bias, and you multiply them by millions of participants acting simultaneously on a trading floor.
That is how you generate the macro-level chaos we observe in the markets.
Which brings us to Section 3, Real-World Chaos and the Psychology Cycle. The literature synthesizes this chaos into 8 distinct market observations of behavioral finance. Let's run through these quickly.
Sure. Observation 1. Fear of loss vastly outweighs the joy of reward. We covered that with prospect theory.
Right. Observation 2. Overconfidence in bull markets is fueled by shockingly limited good news.
Yes. During a historic bull run, when a rising tide is lifting all boats, investors convince themselves their stock-picking strategy is flawless, based on a tiny sliver of positive momentum.
Okay, observation 3. I want to zero in on this one because it's wild. Why does a colorful, well-designed 5-page report manipulate investors more than hard, relevant data?
It is a well-documented observation. You can hand an analyst a raw, dense spreadsheet containing absolutely critical data showing a company is heavily leveraged and facing headwinds.
Hard facts.
Right. Then you hand them a glossy, beautifully designed PDF with incredible graphics and a compelling story about the CEO's grand vision. The human brain will naturally prioritize the slick brochure.
Because we are a storytelling species.
Exactly. The narrative provides a cognitive ease that the raw data lacks, so the investor unconsciously lets the colorful report dictate their expectations.
That leads to observation 4, random decision-making among identical choices.
Right. When confronted with several nearly identical investment vehicles, say 5 different index funds with slightly different expense ratios, investors get overwhelmed by choice and simply pick one at random, or the one with the most recognizable name.
Observation 5, using arbitrary metrics.
Yeah, an investor will pull up a stock chart and notice the 52-week high is $100 and the 52-week low is $50. The stock is currently trading at $52.
So their brain anchors to that arbitrary historical range?
And they assume the stock must bounce back up because it's near the bottom. They buy it, oblivious to the fact that the company just lost its biggest client and is rapidly heading towards zero.
The 52-week range is just a historical artifact, but investors treat it like a gravitational floor.
Right. Which ties into observation 6, the gambler's fallacy. Illogical predictions of random future events.
Like assuming a stock that has had 5 down days in a row is quote-unquote due for a rally.
Exactly. Attempting to profit from random price movements that have zero fundamental connection to the company.
Observation 7, recency bias.
We assume the most recent data point is inherently the most accurate, simply because it is the newest. A stock price drops because one analyst downgrades it on a Tuesday. The market panics, completely ignoring the fact that 20 other analysts looked at the exact same data on Monday and rated it a strong buy.
The Tuesday report feels more urgent purely because of its recency. And finally, observation 8, herd mentality, conforming to others to seek acceptance.
The psychological pressure to conform to the consensus is overwhelming. If everyone around you is buying obscure internet domains in 1999, the primal brain screams that the collective group must know something you don't.
Right, the old how can millions of people be wrong?
Exactly. Even if the asset crashes, it's psychologically easier to fail conventionally along with everyone else than it is to fail unconventionally on your own.
Wow. Okay, so when you string that herd mentality together over a timeline, you produce the investor psychology cycle, the emotional roller coaster.
And this is crucial for the exam. You need to know these 10 stages. This is the anatomical blueprint of every major market cycle in history.
Let's map it out for them, starting from the ashes of a crashed market. Stage 1 is contempt.
Right. At the absolute bottom of a bear market, the general public views equities with sheer contempt. They have lost money, and they swear the market is a rigged casino.
Ironically, this is mathematically the best possible time to buy because valuations are incredibly cheap.
But the emotional trauma keeps the herd paralyzed. Then, the market starts to quietly tick upward. This moves us to stage 2, doubt.
They see the green on the screen, but they don't trust it.
Right. They think it's a dead cat bounce. As the upward trend sustains itself, we inch into stage 3, caution.
A few observant investors start to tentatively allocate capital here, right?
Yeah, they see the fundamentals improving, but they keep their positions small. But the trouble doesn't come. The prices keep climbing, and that caution melts into stage 4, confidence.
The broader public starts to realize a genuine recovery is underway. People start checking their brokerage accounts again.
And actively buying in, creating a self-fulfilling loop. That rising action accelerates into stage 5, enthusiasm.
Portfolios are showing strong gains. The market feels easy.
Interestingly, this is usually the exact moment when the smart money, the institutional value investors who bought during the contempt phase, start quietly scaling out of their positions.
Because they recognize the market is detaching from fundamentals. But the retail crowd doesn't notice because they are entering stage 6, greed.
The danger zone. IPOs start flying. Enthusiasm becomes a frenzy. The only fear anyone has is FOMO. People start using margin to buy more assets.
Which brings us to the absolute peak. Stage 7, indifference.
Asset prices have reached astronomical highs. PE ratios are indefensible. But investors become completely indifferent to fundamental valuation metrics.
But without new buyers, the momentum stalls and the bubble pops. The initial drop introduces stage 8, dismissal.
The market takes a sharp hit, but the herd dismisses it as a healthy correction. They confidently tell each other to buy the dip.
But it doesn't restart. We enter stage 9, denial.
Portfolios are showing severe losses, but investors are anchored to the peak prices. They refuse to sell, fundamentally denying the macroeconomic shift.
And finally, the floor gives way entirely. Stage 10, fear, panic, and contempt.
Margin calls force investors to liquidate regardless of price. Blind panic selling at the absolute bottom of the market just to make the bleeding stop. They swear off the market forever, and we return perfectly to stage 1.
It's a tragic irony. Human nature forces us to buy at the absolute top during greed and sell at the absolute bottom during panic.
Our instincts are perfectly calibrated to destroy wealth.
So how do we build a defense mechanism? That brings us to section 4, market mechanics and the behavioral portfolio.
Right. You can't just turn off your emotions, but you can build a structure that manages them. This portfolio is based on Harry Markowitz's theory, but constructed as a pyramid.
Okay, let's detail the layers of this pyramid for the listener to memorize.
It's built from the ground up, moving from the need for safety up to the desire for aspirational wealth. The foundation, the widest and most robust base, is cash.
Functionally, cash doesn't generate a high return, but psychologically, having a large liquid cash reserve satisfies the primal need for security.
Exactly. Sitting right above that is the next layer, bonds. This satisfies the need for steady, predictable income with a low probability of default.
Then the middle layer, stocks, designed for growth and capital appreciation.
Above equities sits real estate, tangible permanence along with potential growth.
And at the very top, the narrowest point, options.
Highly speculative. This satisfies the human desire to gamble, to take a high-risk shot at a massive reward, but constrained to a tiny sliver of your wealth.
And the genius here is mental accounting, right?
Yes. Each layer serves a distinct purpose and matches a specific risk tolerance. If the stock market crashes, your primal brain might scream to panic. But because your rent money is secure in the cash layer, you have the psychological fortitude to leave your stocks alone.
So it creates emotional firewalls. Now, let's look at the macro mechanics. How do these behavioral anomalies persist if markets are supposedly efficient?
Well, behavioral finance introduces two main characters in the market. Character one is the noise traders.
These are the investors who trade randomly, rely on trends, ignore base rates, and suffer from overconfidence.
Right. They are driven by the noise of the market, and when they act collectively, they shift aggregate demand. Character two is the arbitrageurs.
The rational players guided by fundamentals.
Exactly. When the noise traders panic and push the stock price 20% below its true value, the arbitrager steps in, buys it, and waits for the market to regain its sanity.
But wait, here's a massive exam concept. The limits of arbitrage. Because if arbitrageurs are so smart, why don't they just correct the mispricing immediately and make free money?
Because correcting the market carries massive risks. Arbitrageurs face two massive risks. First is fundamental risk.
Meaning the undervalued stock might just keep dropping because the company is actually terrible.
Right. The second barrier is the true killer, resale price risk.
And this is tied to leverage, right? They trade on borrowed funds.
Exactly. They trade on margin. Let's say an arbitrager shorts a massively overvalued stock. They are mathematically correct. But the noise traders keep buying, pushing the price higher.
And the arbitrager gets a margin call. They have a limited time horizon.
Right. If they run out of capital, they're forced to liquidate at a catastrophic loss. They can't stay solvent long enough for the market to become rational again.
Okay, moving into the final stretch. Section 5. Practical applications and the critic's counterattack. Theory is great, but how do professionals actually use this to make money?
The text lists several applications. First, rectifying personal investing mistakes, building better internal frameworks.
Second, adapting to others' irrational decisions, monetizing the herd's biases.
Third is evaluating market trends via technical analysis, predicting future price movements based on cyclical human behavioral patterns.
Fourth, facilitating financial planning, forecasting how people will behave, not how they should.
Fifth, predicting the impact of one-time events on the market, anticipating the overreaction and the slow recovery drift.
And sixth, marketing and product promotion. I want to pause here because the text highlights an ethical gray area, studying decision-making errors specifically to exploit consumers.
Right. Corporations design their pricing architecture to specifically trigger consumer heuristics, anchoring you with an artificially high original price, for example.
So we've covered the behavioral side, but I want to play devil's advocate here. Isn't this entire field just a random collection of anomalies rather than a cohesive theory?
And that is exactly the counterattack from the traditionalists. You need to know these critiques for the exam.
Okay, let's outline the heavy critiques.
The first critique is that mispricing is temporary. Eventually, market forces and arbitrage normalize prices back to intrinsic value.
Second, empirical evidence sometimes contradicts behavioral claims. Like loser portfolios actually tend to outperform winner portfolios over the long term, even after risk adjustment.
Third, it is criticized for being more theoretical than practical. It diagnoses problems in hindsight, but lacks a unified predictive model.
Fourth, it falsely shifts the blame for societal or macro market failures onto the psychological flaws of individual retail investors.
Which absolves the structural failures of regulatory bodies. And the ultimate critique. Micro-level individual biases do not translate to macro-level market movements.
Meaning millions of random psychological errors naturally cancel each other out in the aggregate.
Exactly, leaving the macro market perfectly efficient.
All right, let's synthesize this journey for your MBA exam prep. We've covered the traditional versus behavioral divide. You know the specific cognitive and heuristic biases, like confirmation bias and anchoring.
You've got the market cycle memorized, from contempt to panic, and the behavioral portfolio pyramid.
And you understand the limits of arbitrage, the real-world applications, and the academic critiques. You are fully armed for this exam.
You absolutely are.
But before we sign off, I want to leave you with a provocative final thought. We talked extensively today about how human emotional biases like fear, overconfidence, and mathematical illiteracy create these market anomalies.
Right, the human friction.
But as we move into an era where algorithmic trading and AI handle the vast majority of stock market transactions, we have to wonder, Will these behavioral anomalies eventually disappear from the market entirely?
That is the big question.
Or, because those AI models are trained on historical human data, will the machines just end up perfectly mimicking our own irrational panic and greed?
Something to think about.
Good luck on your exams.